This next topic is on fair value reporting for these investments. But first, we are going to do an overview of all the reporting methods. In order to determine the reporting method, we need to know if it's a debt or equity security. For debt securities, we need to know the holding intent, whether it's short or long term. For equity securities, we need to know the percent ownership, which means how much of the company do we own. Let's first look at debt securities. We need to know the holding intent. There are three holding intents. The two that we will be exploring this chapter are trading and available for sale. I will discuss what these mean in more detail in the next topic, but as a quick explanation, trading securities are short term. Available for sale securities can either be short or long term, but the intent is still to redeem them before the maturity date. No matter which one the investment is classified as, we will be using the fair value method for both. Bonds can also be held to maturity. In this case, we will use the amortized cost to report it on our books. However, we will not be covering this method in this course. This topic will be covered in an intermediate accounting course. Next, we have the equity or the stock securities. For these, we need to know the percent ownership. Did you buy just a few shares of the company stock, or did you purchase a huge chunk of their available shares? The three ownership percentages are if you own less than 20% of their stock, 20 to 50%, or more than 50%. If you own less than 20%, you will use the fair value method, which is the same for the debt securities we will cover. If you own 20 to 50% of their stock, you will use the equity method. We will cover this in our last topic of the chapter. If you own more than 50%, you will use the consolidation method where you combine the financial statements of your company and the invested company since you essentially own them. However, we will not be covering this topic in this course either. This topic is usually covered in an advanced accounting course since it is one of the most difficult concepts. We will not be preparing entries for the grayed out security types. For this topic, we are covering the fair value method only. This will be for the debt investments, whether trading or available for sale, and for stock investments with less than 20% ownership. We're now going to be preparing the journal entries for the two debt securities and the stock securities under 20% ownership. We will prepare the entries for purchasing the securities, recognizing any interest or dividends, and then selling them. First, let's look at the entry to purchase these securities. By the way, the fair value method is also called the cost method because you record the purchase at your cost. You would either debit debt investments for bond purchases or stock investments for stock purchases. The red color indicates where you would choose. The label would either be trading or available for sale. You never need to guess. The problem would tell you which one to use. So some examples would be debt investments dash available for sale or dash trading. Also, stock investments dash trading or dash available for sale. The credit would be cash because you need to spend cash in order to purchase the bonds or stock. The amount would be for how much you spent on it. Next, we will look at the entries for receiving dividends or interest. If it's a stock investment, you would be receiving dividends, and if it's a debt investment, you would be receiving interest. The journal entry consists of debiting cash because we will be receiving cash and crediting either interest revenue or dividend revenue. You would choose one. The entry is pretty straightforward. However, determining the amount is a little more difficult. For bonds, to determine the interest revenue amount, you would multiply the par value by the interest rate by the portion of year, similar to what we did in Chapter 14. In Chapter 14, we would divide by 2 because interest was paid semi-annually. We are going to be doing the same thing in this chapter. Multiply the par value by the interest rate, then divide by 2. For stock investments, you would calculate the dividend revenue by multiplying the dividend per share rate by the number of shares you own. For example, if the company was paying out $2 per share and you owned 100 shares, you would receive $200. Now we will look at entries for selling these investments. These can get a little tricky. First, you want to debit cash for the amount you are selling the investment for. Then skip down to the last line for a moment. Credit the investment account. This should match the account name from the first entry. It would either be debt or stock investments, and you would label it as either trading or available for sale. The amount would be your purchase price, not the sale price. The reason is we want to see how much we gained or lost on the sale. If you bought something and you wanted to know how much you would make on selling it, you find the difference between what you paid for it and what you sell it for. That is the same thing here. Cash is what we are selling it for, and the investment account is what we paid for it. The difference will be our gain or loss. These rules are the same as what we learned in Chapter 14. Find the difference between the two accounts and put that amount on the smaller side. Remember my corny saying to remember if it's a gain or loss? Left side is the loss side, LL, and gains are all right, meaning gains are on the right side. But common sense can also help in this case. If you received more cash than what you paid for it, then you are gaining money. If you are receiving less, then you are losing money.